Understanding liquidity, the foundation of trading. Liquidity is a fundamental concept in financial markets. In simple terms, liquidity refers to how easily an asset can be bought or sold quickly without causing a significant change in its price. Think of it like water in a river. A deep, wide river or high liquidity allows large boats or big trades to pass through smoothly. A shallow, narrow stream or low liquidity would make it difficult for even small boats to navigate without disturbing the flow. For traders, especially those focusing on active markets like the Nifty 50 index, understanding liquidity is absolutely crucial for effective participation and strategy execution. It forms the bedrock upon which successful trading decisions are often built. The importance of liquidity in trading cannot be overstated. When a market is liquid, traders can enter and exit positions with relative ease. This means if you want to buy Nifty futures or options, there are readily available sellers at competitive prices. Conversely, if you wish to sell your holdings, there are ample buyers. This ease of transaction reduces the risk of being stuck in a position you no longer want. Furthermore, high liquidity typically leads to tighter bid-ask spreads. The bid-ask spread is the difference between the highest price a buyer is willing to pay, or bid, and the lowest price a seller is willing to accept, or ask. A smaller spread means lower transaction costs for traders, directly impacting profitability over time. Trading in a liquid market like the Nifty index offers several distinct advantages, particularly for beginners. The Nifty 50, representing the weighted average of 50 of the largest Indian companies, generally experiences substantial trading volume. This high volume ensures that price movements are usually more orderly and less prone to extreme, erratic swings caused by single large trades. For someone new to trading, this predictability, though not absolute, provides a more stable environment to learn and apply strategies. Moreover, the abundance of information and analysis available for a liquid index like Nifty helps in making more informed decisions, fostering a better learning curve for novice participants in the market. Therefore, grasping the concept of liquidity is the first step towards mastering trading in instruments like the Nifty. It influences everything from your ability to execute trades efficiently to the overall cost of your trading activities. Without sufficient liquidity, even the best trading strategy can falter, as executing trades at desired prices becomes challenging. As we delve deeper, we will explore how to identify these crucial liquidity zones within the Nifty index. Understanding where liquidity resides can provide valuable insights into potential price movements and help in formulating more robust trading plans, which is essential for navigating the dynamic Indian stock market effectively. Identifying where liquidity is concentrated in the Nifty index is a key skill for traders. One of the most direct indicators of liquidity is trading volume. High trading volume in Nifty futures or its constituent stocks suggests that many shares are being bought and sold. This activity indicates a strong interest from various market participants, including institutional investors and retail traders. When volume is high, it generally signifies that the current price levels are attracting significant engagement, making it easier to transact. Traders often look for spikes in volume around certain price levels, as these can signal areas where substantial buying or selling interest, and thus liquidity, is present. Another important method to gauge liquidity in the Nifty is by examining the bid-ask spread. As mentioned earlier, this spread represents the immediate cost of trading. In a highly liquid market for Nifty contracts, you will observe a narrow bid-ask spread. For instance, the difference between the buy price and sell price for Nifty futures might be just a few paisa or a single tick. Conversely, if the spread widens considerably, it indicates lower liquidity, meaning it's more expensive to get in and out of trades. Monitoring the spread, especially during volatile market conditions, can provide real-time feedback on the available liquidity within the Nifty index at any given moment. The depth of the market, often visible through an order book, is also a critical tool for identifying liquidity. The order book displays the list of buy orders or bids and sell orders, or asks, at different price levels for Nifty contracts. A deep market will show a significant number of orders stacked up on both the buy and sell sides, even away from the current market price. This depth signifies that large orders can be absorbed without drastically moving the price. If the order book is thin, with few orders at various price points, it suggests lower liquidity, and a large trade could cause a substantial price shift, which is a risk traders need to be aware of. Finally, understanding the behavior of large market participants can help in identifying potential liquidity zones. Institutional investors often place large orders, which can create significant pools of liquidity. While their exact orders are not always visible, their activity can sometimes be inferred from price action around key technical levels, such as previous highs and lows, round numbers like Nifty at 23,000, 23,500, or significant support and resistance areas. These areas often attract a confluence of orders, thereby becoming temporary pockets of high liquidity. Recognizing these patterns requires observation and experience in watching the Nifty's behavior over time. Basic strategies. Trading around Nifty's liquidity zones. Once you can identify areas of liquidity in the Nifty, you can start formulating basic trading strategies around them. One common approach is to look for price reactions at these liquidity zones, which often coincide with established support and resistance levels. For example, if the Nifty approaches a level where significant buy orders, a liquidity pool, were previously observed or are expected, traders might anticipate the price to bounce or find support there. They might then look for entry signals to go long. Conversely, if the price approaches a zone with many sell orders, it might act as resistance, offering potential short-selling opportunities after confirmation. Liquidity can sometimes act like a magnet for price. Large pools of buy or sell orders represent areas where significant transactions can occur. Algorithmic trading programs and institutional traders are often aware of these zones and may drive prices towards them to execute their large orders or to trigger stop-loss orders, which themselves represent a form of liquidity. For a beginner Nifty trader, observing how price behaves as it nears these well-defined liquidity areas can be very insightful. For instance, if Nifty is trending strongly towards a known prior high, a potential sell liquidity zone, one might watch for signs of slowing momentum or reversal patterns. Breakout trading is another strategy that utilizes the concept of liquidity. When the Nifty price is consolidating within a range, liquidity tends to build up above the resistance and below the support of that range, often in the form of stop-loss orders and pending breakout orders. A strong move that breaks out of this consolidation, accompanied by high volume, can indicate that one side, buyers or sellers, has overwhelmed the liquidity of the other. Traders might enter in the direction of the breakout, anticipating that the absorption of liquidity will lead to a sustained move. However, it's crucial to be wary of false breakouts, where price briefly breaks a level only to reverse. A more advanced, yet basic in concept, strategy involves fading moves into liquidity zones, especially if the broader market context does not support a continued move. For example, if the Nifty makes a sharp, rapid move towards a known resistance level, sell liquidity on low overall market conviction, some traders might anticipate that the move will exhaust itself as it hits the sell orders. They might then look for signs of rejection at that level to take a counter-trend position, betting that the liquidity will absorb the buying pressure and push prices back down. This requires careful risk management, as fading strong moves can be inherently risky if the liquidity doesn't hold. Navigating the water's risks, rewards, and key takeaways. Trading based on liquidity in the Nifty index offers several potential rewards. The primary advantage is often improved trade execution. By targeting entries and exits around areas of high liquidity, traders can typically expect quicker fills for their orders and, importantly, tighter bid-ask spreads. This reduction in slippage and transaction costs can significantly enhance overall profitability, especially for active traders who execute multiple trades. Furthermore, understanding liquidity flows can provide a clearer rationale for why prices might stall or reverse at certain levels, leading to more confident decision-making and potentially higher probability setups when combined with other analytical tools. However, liquidity trading is not without its risks. One major risk is the occurrence of false breakouts or liquidity grabs. Price might appear to break a key level, triggering stop orders and attracting breakout traders, only to sharply reverse as large players absorb this activity and push the market in the opposite direction. Another risk involves liquidity traps, where apparent liquidity dries up suddenly, perhaps due to a news event, leading to sharp, unexpected price moves and wider spreads, making it difficult to exit positions favorably. Relying solely on visible liquidity like order book depth can also be misleading, as large hidden orders or iceberg orders can significantly impact price without being immediately apparent. Consider a practical example in the Nifty. Suppose the Nifty has repeatedly bounced from the 23,000 level, establishing it as a strong support zone where buy liquidity is perceived to be high. A trader might look to buy near this level if the price approaches it again, expecting the accumulated buy orders to hold. The reward is a potential bounce upwards. However, the risk is that this time the selling pressure might be too strong, breaking below 23,000 and triggering stop-loss orders below it, leading to a sharp decline. This highlights the need for confirmation signals and robust risk management, such as placing a stop-loss order below the liquidity zone. In conclusion, understanding and identifying liquidity is a valuable skill for Nifty traders, especially beginners. Key takeaways include recognizing that liquidity facilitates smoother trading, reduces costs, and can define important price zones. Beginners should start by observing volume, bid-ask spreads, and price action around significant Nifty levels. Always remember that liquidity is dynamic and can change rapidly. Therefore, it's crucial to combine liquidity analysis with other forms of technical or fundamental analysis. Start with small position sizes, practice diligently on a demo account if possible, and always prioritize risk management to protect your capital while navigating the exciting world of Nifty trading.